Section 1, Showdown ETFs versus mutual funds. Investors have choices. Two popular options are ETFs and mutual funds. Both offer ways to invest in stocks, bonds and other assets, but they have key differences. Understanding these differences is crucial. This essay will break it all down. We'll compare ETFs and mutual funds head to head. By the end, you'll know which one is right for you. This isn't about picking a winner, it's about finding the best fit for your investment goals. Whether you're just starting or a seasoned pro, this guide is for you. Let's get ready to rumble. Section 2. What are these investment vehicles? ETFs and mutual funds are both baskets of investments. Think of them like a fruit salad for your money. Instead of apples and oranges, they hold stocks, bonds or other assets. ETFs stand for exchange-traded funds. They trade on stock exchanges just like individual stocks. You buy and sell ETFs throughout the trading day. Their prices fluctuate in real time. Mutual funds are like the older, more traditional sibling. You buy and sell mutual fund shares through the fund company. Their prices are calculated only once a day after the market closes. Section 3, Inside the Engine. How ETFs and mutual funds work. When you buy an ETF, you're buying a small ownership in that basket of assets. Let's say an ETF tracks the S&P 500. When you buy a share, you own a tiny piece of all 500 companies in that index. Mutual funds pool money from many investors. This money is used to buy a portfolio of assets. When you buy shares, you own a piece of that portfolio. Both ETFs and mutual funds offer diversification. This means spreading your risk across different investments. It's like the old saying, don't put all your eggs in one basket. Section 4, Trading Face-Off. ETFs take the lead. ETFs have a big advantage here. They trade on exchanges just like stocks. This means you can buy or sell them anytime during market hours. You get real-time pricing and can react to market moves quickly. Mutual funds are different. You can only buy or sell them at the end of the trading day. The price you get is based on the fund's net asset value, or NAV, calculated after the market closes. This can be a disadvantage if you need to buy or sell quickly. Imagine the market takes a sudden dip. With an ETF, you can sell immediately to cut your losses. With a mutual fund, you're stuck waiting until the next trading day. By then, the market might have fallen even further. Section 5. The price is right cost considerations. When it comes to investing, understanding the costs involved is crucial. Both ETFs and mutual funds charge fees, but the structure and amount of these fees can vary significantly. These fees are often referred to as expense ratios, which represent the annual cost of owning a fund. Expense ratios cover the costs of running the fund, such as management fees, administrative expenses, and other operational costs. ETFs are particularly known for their low costs. This is one of their main selling points. Because they are passively managed, tracking an index rather than trying to outperform it, their expense ratios are typically lower than those of mutual funds. This means more of your money stays invested and working for you, rather than being eaten up by fees. On the other hand, mutual funds can have higher expense ratios, especially those that are actively managed. Active managers try to beat the market, which requires more research, analysis, and frequent trading. These additional efforts and resources are costly, and these costs are passed on to investors through higher fees. Think of it this way: every dollar you pay in fees is a dollar that's not growing in your investment account. Over time, these fees can add up. Over time, even small differences in fees can make a big difference in your returns. Lower fees mean more money stays in your account, compounding and growing over the years. Section 6. Performance anxiety. Do ETFs or mutual funds win? There's no clear winner here. The debate between ETFs and mutual funds is ongoing and complex. It depends on the specific ETF or mutual fund you're looking at. Each has its own unique set of characteristics and performance metrics. Some ETFs and mutual funds outperform the market, while others lag behind. This variability can make it challenging to choose the right investment. It's important to do your research and compare their track records. Look at historical data, management styles, and fee structures. Passively managed ETFs tend to perform better over the long term. They offer a low-cost way to invest in a broad market index. They track a specific index, such as the S&P 500. This means they mirror the performance of the index they follow. This means they're not trying to beat the market, just match it. This strategy can lead to more stable returns over time. Actively managed mutual funds aim to outperform the market. Fund managers use their expertise to select investments they believe will do well. However, this is not always successful. The pressure to outperform can lead to higher fees and increased risk. In fact, many actively managed funds fail to beat their benchmark indexes after fees are taken into account. This can erode potential gains. Remember, past performance is not indicative of future results. Market conditions change, and what worked in the past may not work in the future. Just because an ETF or mutual fund has done well in the past doesn't guarantee it will continue to do so in the future. Always consider your own financial goals and risk tolerance when making investment decisions. Section 7. Taxman cometh. ETFs have an edge. When it comes to managing your investments, understanding the tax implications is crucial. Taxes can eat into your investment returns, reducing the overall growth of your portfolio over time. ETFs are generally more tax efficient than mutual funds, making them an attractive option for many investors. This is because they have lower turnover rates, which means they buy and sell securities less frequently, leading to fewer taxable events. When a mutual fund manager buys or sells securities within the fund, it can trigger capital gains distributions, which are then passed on to the investors. These distributions are taxable, even if you reinvest them within the fund, potentially increasing your tax liability. This can drag down your overall returns, as a portion of your gains is lost to taxes. ETFs, on the other hand, are less likely to generate capital gains distributions due to their structure and management style. This is because they are passively managed and have lower turnover rates, which minimizes the number of taxable events. This can save you money on taxes in the long run, allowing more of your investment to grow over time. Of course, tax laws can be complex and vary depending on your individual circumstances, making it essential to stay informed. It's always a good idea to consult with a qualified tax advisor for personalized advice, ensuring you make the most tax-efficient investment decisions. Section 8. Real-world rumble examples of ETFs and mutual funds. Let's look at some real-world examples. One popular ETF is the SPDR S&P 500 ETF, also known as SPY. It tracks the S&P 500 index, which includes 500 of the largest US companies. A well-known mutual fund is the Fidelity Contra Fund, ticker symbol FCNTX. It's an actively managed fund that invests in large-cap growth stocks. The fund manager uses a bottom-up approach to stock picking, looking for companies with strong earnings potential. These are just two examples of the many ETFs and mutual funds available to investors. It's important to do your research and choose investments that align with your financial goals and risk tolerance. Section 9. The decision which one is right for you. So, which one should you choose, ETFs or mutual funds? The answer depends on your individual needs and investment goals. If you're looking for low costs, trading flexibility and tax efficiency, ETFs might be a good choice. They're also a good option for investors who are comfortable with a passive investment approach. Mutual funds might be a better fit if you prefer professional management or want to invest in a specific sector or theme. Keep in mind that actively managed funds can come with higher fees. It's important to remember that there's no one-size-fits-all answer. The best investment for you will depend on your individual circumstances. Section 10. The bottom line, investing for your future. ETFs and mutual funds are both valuable tools for building a diversified investment portfolio. Understanding their differences is crucial for making informed investment decisions. Whether you choose ETFs or mutual funds, the most important thing is to start investing early and stay invested for the long term. The power of compounding can help your money grow over time. Remember, investing involves risk. It's essential to do your research, understand the risks involved, and invest only what you can afford to lose.